Let's take a deep dive into a recent major event in the crypto world and why it may have quietly affected your portfolio. You may be surprised to find that even if you have never downloaded any cryptocurrency trading apps or bought even a single Bitcoin, crypto assets may have quietly entered your retirement account or portfolio. According to a report by Jeff Sommer, a columnist for the New York Times on June 13, 2025, many portfolios containing broadly diversified index funds already indirectly hold Bitcoin. This may sound incredible, but this is exactly the starting point for our in-depth discussion today. Crypto assets are merging with the traditional financial world we are familiar with in an unprecedented way. And a bill recently passed by the US Senate has stepped on the accelerator for this fusion. The passage of the Genius Act, a key step for crypto assets to go from grassroots to regular army. First, let's talk about this significant bill. According to Yahoo Finance and the New York Times, the US Senate passed a bill called the Genius Act on June 17, 2025, with a vote of 68 to 30. The name is an abbreviation for Guiding and Establishing National Innovation for US Stablecoins, which is the Guiding and Establishing National Innovation for US Stablecoins Act. The core significance of this bill is that it establishes the first federal regulatory framework in US history for a cryptocurrency called stablecoins. What does this signify? This marks a huge step for the crypto industry towards gaining official credibility and legitimacy in Washington. For a long time, the crypto world has been regarded by many traditional investors and regulators as a casino in the wilderness, full of speculation and lack of regulation. The passage of the Genius Act is like building the first legally based city in this wilderness. It means that, at least in the field of stablecoins, the rules of the game are being established. You may ask, what is a stablecoin? Why is it so important? Simply put, a stablecoin is a cryptocurrency whose value is pegged to a traditional fiat currency such as the US dollar. For example, the most common US dollar stablecoin aims to keep the value of a token approximately equal to $1. They were designed to avoid drastic price fluctuations like Bitcoin, so they are seen as a bridge between the crypto world and the traditional financial world. According to the bill, the issuer of stablecoins must hold sufficient cash or U.S. Treasury bonds as reserves, undergo regular audits, and disclose the status of their assets to the public. This set of rules is actually very similar to the money market funds we are familiar with. This regulatory requirement has greatly improved the reliability of stablecoins. So, what practical applications does it have for the world and individuals? What impact will it have on our daily lives? First, it is an efficient global payment and settlement tool. Imagine that you need to make a cross-border remittance. The traditional banking system may take several days and the handling fee is high. Supporters of stablecoins believe that due to its near-instant settlement characteristics, it can greatly improve the efficiency of cross-border transactions and reduce costs. This is a huge potential advantage for international trade and personal remittances. Then, it provides a wider channel to reach the US dollar. In many parts of the world, it is not easy to obtain and use US dollars. Stablecoins can provide millions of people around the world with a more convenient channel to access the US dollar. This not only helps individuals preserve their assets, but also enhances the dollar's dominance in the global digital economy from a macro perspective. It is foreseeable that the dollar will be used more widely around the world than at any time in history. In addition, it is the foundation of financial innovation. Stablecoins are considered to be the cornerstone of more financial innovations in the future. For example, it can be used in decentralized finance, DeFi, applications or as a tool for large-scale, efficient fund settlement between companies. As Brian Moynihan, CEO of Bank of America, said, they are exploring the prospects of stablecoins with the industry. There are even reports that retail giants such as Amazon and Walmart are also studying and advancing related layouts. The passage of this bill will undoubtedly encourage more traditional financial giants and technology companies to enter this field. U.S. Treasury Secretary Scott Bessent has high expectations for this. He once told lawmakers that this legislation could push the U.S. stablecoin market to more than $2 trillion by the end of 2028. In another report, he even predicted that this market could grow into a $3.7 trillion market by the end of this year. This growth will directly stimulate private sector demand for U.S. treasuries, which are the main reserve asset backing stablecoins, and may even help reduce the government's borrowing costs. Of course, the bill has also sparked a lot of controversy. Some Democratic lawmakers, such as Senator Elizabeth Warren, have severely criticized the bill for its lack of regulatory strength, believing that it is laying the groundwork for a repeat of the 2008 financial crisis. In addition, the bill's failure to prohibit the president and his family from profiting from the stablecoin business has also become a major point of contention. In fact, President Trump's family has already been involved in the industry, and its backed startup World Liberty Financial has launched its own stablecoin $1. Despite the controversy, the passage of the bill in the Senate is an indisputable fact, and it sends a strong signal to the world. Crypto assets, especially stablecoins, are being included in the regulatory vision of mainstream finance. For traditional investors, its impact, more than just coins, an asset revolution is taking place. Now let's go back to the question mentioned at the beginning: why might you already have crypto assets in your portfolio? This part is crucial for every investor in the traditional capital market. First, crypto assets have penetrated into mainstream investment portfolios through the channels of traditional stock markets. Many companies that are part of the S&P 500 index already hold cryptocurrencies such as Bitcoin as part of their balance sheets. For example, Tesla holds more than $1 billion in Bitcoin. Another company called Strategy, formerly MicroStrategy, has Bitcoin as its main asset. In addition, Coinbase, the largest cryptocurrency trading platform in the United States, is itself a public company and has also been included in the S&P 500 index. When you buy an index fund that tracks the S&P 500, you indirectly hold shares of these companies and indirectly have exposure to crypto assets. You may have heard of Bitcoin spot ETFs. For example, IBIT, GBTC and ARKB. This is a more direct channel. Since the beginning of 2024, the US Securities and Exchange Commission has approved exchange-traded funds that directly hold Bitcoin. ETFs provide an extremely convenient investment channel for individuals and institutions that are unwilling or unable to buy cryptocurrencies directly. As of May 2025, there are 91 such funds on the market. Among them, the iShares Bitcoin Trust, IBIT, launched by asset management giant BlackRock, is huge in scale, holding more than $72 billion in Bitcoin as of mid-June. More notably, BlackRock has begun to allocate such Bitcoin funds as alternative assets to some investment portfolios in small batches to increase investment diversification. So, unless you deliberately exclude these assets from your holdings, you are likely already a crypto investor. However, if crypto assets are only understood as virtual currencies, such as Bitcoin or Ethereum, it greatly underestimates the revolutionary changes they bring. Stablecoins and the Genius Act open up a broader future, the tokenization of real-world assets, RWA. This is the most profound and long-term impact of crypto technology on traditional capital market investors. The core logic here is, almost any valuable real-world asset, whether it is stocks, bonds, real estate, art, or even carbon credits, can be tokenized. In other words, the ownership or income rights of these assets can be represented, traded and transferred on the blockchain in the form of digital tokens. Stablecoin is the simplest and most direct example of RWA. It tokenizes the real-world asset, dollar. And the Genius Act provides it with regulatory certainty. Next, this revolution will expand to a wider range of asset classes. Take US Treasuries as an example. At present, giants like BlackRock have launched tokenized US Treasury funds, such as its BITL fund. Investors no longer buy traditional fund shares, but a token issued on the blockchain. Each token represents the ownership of a portion of US Treasury bonds in the fund. What revolutionary changes will this bring? First, it will make assets extremely liquid and divisible. A commercial property worth millions of dollars is out of reach for ordinary investors. But if it is tokenized, it can be divided into millions of tokens, each of which represents a very small portion of ownership of the building. In this way, anyone can invest in the building with very little money, and these tokens can be traded 24 hours a day on the global market, 7 by 24 hours a day, and liquidity is greatly enhanced. Second, it can greatly improve efficiency and reduce costs. traditional asset transactions involve a large number of middlemen, such as brokers, custodian banks, clearing houses, etc., and the process is long and costly. Blockchain-based tokenized asset transactions can use smart contracts to automatically execute transactions and settlements, bypass many intermediate links, and achieve near real-time, one hand for money, one hand for goods, thereby greatly improving efficiency and reducing costs. Third, it has strong transparency and traceability. Blockchain is an open, tamper-proof distributed ledger. Every transaction is recorded and anyone can query it while protecting privacy. This greatly improves the transparency of asset ownership and transaction history and reduces the possibility of fraud and disputes. Why can this be done? The core technology behind all this is blockchain. It is like a super ledger maintained by countless participants and cannot be unilaterally tampered with. When an asset is tokenized, its ownership record is transferred from the traditional centralized database to this decentralized superledger. Regarding its security and reliability, this is exactly the core problem that regulatory laws such as the Genius Act try to solve. For stablecoins, the bill ensures the stability of their value and the security of their assets by mandating full cash or highly liquid treasury bonds reserves, regular audits and information disclosure. Dante Dispart, Chief Strategy Officer of Circle, is very confident that this bill can 100% protect financial stability through transparency reports, audit requirements and criminal penalties for violations. For the broader RWA tokenization, similar regulatory frameworks will surely emerge in the future to ensure that the underlying assets represented by the tokens are real, properly kept, and their rights and obligations are clear. Now that the crypto world has broken into our reality, how will the integration continue? The integration of the crypto market and the traditional capital market is no longer a question of whether it will happen, but how fast and how deeply it will happen. The Genius Act paves the way for stablecoins, which is just the first step. We can foresee that the next legislative and regulatory focus will shift to the broader field of RWA tokenization. Regulators will gradually formulate clear rules for tokenized stocks, bonds, real estate and other asset classes. After the passage of the Genius Act, we can expect traditional financial giants such as Bank of America and JP Morgan Chase to move from the exploration stage to the practice stage. They may launch their own stablecoins or participate in the issuance and trading platform construction of RWA. This institutional-level participation will bring huge funds and trust to the market. Circle's IPO is a good example. Its stock price soared after listing, showing the great enthusiasm of investors in this field. For ordinary investors, allocating a small portion of tokenized assets in their portfolios in the future may become as common as allocating stocks and bonds today. As Jeff Kendrick, global head of digital assets at Standard Chartered Bank, pointed out, allocating 1% to 2% of Bitcoin in a diversified portfolio may increase overall returns and suppress volatility without adding too much risk, because Bitcoin's price movements are often uncorrelated with traditional stock markets. This logic also applies to other tokenized assets. Nobel Prize winner Harry Markowitz once called diversified investment the only free lunch in investment because it reduces your overall risk by holding everything, including assets that you don't completely agree with. In small doses, cryptocurrencies may help. We are on the eve of a major financial revolution. The core of this revolution driven by crypto technology is not to create a new, unrealistic speculative tool, but to use new technologies to reshape the pipes of our existing financial system, making the flow of assets more efficient, transparent, and inclusive. The passage of the Genius Act is a milestone in this transformation. It symbolizes a shift from confrontation to cooperation, and regulators begin to set boundaries for innovation instead of simply prohibiting it. This provides a foundation for the healthy development of the industry. For traditional investors, what needs to be done now is not to panic, but to understand and accept this trend with an open and prudent mind. You need to realize that crypto assets are no longer just the Bitcoin that is full of myths of skyrocketing and plummeting. It is evolving into a new form of asset that can represent real-world value and may soon appear in your mainstream investment options. Of course, risks still exist. As Jeff Sommer worried at the end of his article, when a once marginal market begins to talk about trillions of dollars, it involves real money, and any potential risks may be magnified, which is enough to make people worry. Therefore, the road ahead is bound to be accompanied by strict regulatory games, technological iterations, and market education. In short, the process of integrating the crypto market into the traditional capital market has started and is irreversible. For investors, the key question is no longer whether to participate, but how to understand it, and how to participate in a wise, prudent and risk-averse way. This requires us to continue learning and look at this ongoing financial revolution with a long-term perspective. The above is a little information and personal opinion shared with you today. Thank you for your company. Let us make progress together.